Hey everyone, this is Motley. Today we are discussing something really interesting, that is interest on shares. Is it possible? Yes, it is possible. It's like interest on our FD, fixed deposit, right? Lump sum of money deposited into your account for a fixed tenure. The money remain in that account for a specific period, for a few days to several years. After that completed, your money got matured, you got your principal amount back along with the accumulated interest. But FD gives you guaranteed fixed interest. That is not you are getting on your shares. So what this interest on share is called? That calls dividend. Dividend is a company's way of rewarding their shareholders when they got profit in their business. It is decided by company's board of directors. Do we get dividend on the price we are selling and buying in the market? No, we are getting dividend on the face value. What's that face value? Where does it come from? When a company is formed, it decides in its memorandum of association and article of association, that is documents of the company, how much capital it wants and how many share it will divide that capital into. Let's say we have a company, Motley and family, okay, and we want 1 crore capital and we issue 10 lakh share. Then each share's face value is 10 rupees, that is 1 crore divided by 10 lakh. So the face value is fixed by the company when it starts issuing shares in that initial stages. Okay, it doesn't change in the market except if the company does a stock split or like consolidation. The price you see in the stock market, the price we are selling and buying the shares, is the market price. It keeps changing daily, but the face value remains constant as per company's records. Let's say we have 100 shares and the face value is 10 rupees, and company decided to give you 20% dividend. You will get 200 as a dividend. That is 10 into 20. Okay, that's not the end. On top of that, the share price itself may rise. So you get double benefit, dividend plus capital appreciation. Is it mandatory for company that when they get profit in their company, in their business, they have to pay their uh, shareholders the dividends? No, it's not mandatory like it was mandatory for banks to give interest on fixed deposit. No, it's not like that. Story time. You know the company Google, right? Google never paid a dividend for decades. Instead, it reinvests all the profits into their growth. They grow their business, they expand their business, they launch many products like search engine, Alexa, YouTube, Android, many others. So what's the result? Does shareholder get anything? Yes, shareholders became millionaires just by holding the stock. It proves even if dividends aren't paid, shareholder win through rising stock prices. Is it like share profit? No, it's not like share profit. Share profit is when you sell the share. That is capital gain. Dividend is when company pay you without selling. That's income. Both are earning from shares, but they are separate categories for tax purpose. Okay. So next question come to your mind is that how do I get that dividend? Company decided that they will give dividend to their shareholder. First, they will declare, that is declaration date. Company announce it will pay dividend. After that, there is another date, that is record date. They will check their list, company's list of shareholders. Whoever is on the list by this date will get dividend. After that, there is another date, that is ex dividend date, usually a one trading day before the record date, that is T plus 1 in many countries. If you buy or on or after the X date, you will not get dividend. Let's say, for example, Amazon declares dividend on 1st of October. Record date is 15th of October. Ex dividend date is 14th of October, one day before. Okay. If you buy on 14th or 15th of October, you don't get dividend. You must buy on or before 13th of October, that is before ex dividend date, and hold till record date, that is 15th of October. So the rule is buy before X date, hold on record date, you get dividend. Buy on or after X date, there is no dividend. You don't have to claim anything in your broker app. The company send dividend money directly to your bank account, the one linked with your app. Sometimes it also credit to your broker ledger, but mostly it goes straight to your bank. Company usually pay within 30 days after declaration. You will get an SMS or email from the company's registrar like K Fintech or LinkedIn Time when dividend is credited. Even if you sell the share after record date, you still get the dividend because you held on record date. You get that what I am talking? If you have any doubts, write down in your comment section. I will answer that. Okay? Now, most of the people use dividend capture strategy. What's that? Buy a stock before the X dividend date you qualify for dividend. Okay. Hold it just through the record date and sell immediately after you capture the dividend without holding the stock long term. Sounds clever, right? But here's the catch. Stock price usually drop on X dividend date. That's why they use this strategy. Why this price you drop? Because the company is paying money to their shareholders. That cash is leaving the company. Theoretically, the stock is worth a little less, but stock may not drop exactly by the dividend amount. Market can go up or down unpredictably, and brokerage and tax reduce your effective gain. If it's in your country, dividend is taxable at slab rate, so after tax, your net dividend is even smaller. Okay, so here is all about dividend. Fixed deposit is good for safety, but it can't make you rich. Shares not only give dividends but also a chance to multiply your money. Even company that doesn't pay dividend like Google reward you through growth. That's why smart investors always give more weight to shares. They are the true wealth creator. If you want your money to grow beyond fixed interest, focus on learning shares. Subscribe now because in this playlist I'll take you from basic to smart investing step by step. Okay, that's all for today. Bye.